Imagine walking into a car dealership, finding the perfect vehicle, negotiating a great price, and feeling confident about your purchase. Then the finance manager pulls up your loan offer, and suddenly, you're staring at an interest rate that's far higher than expected. Meanwhile, another customer with a similar income, similar job, and similar down payment gets approved for a much lower rate. What made the difference? It wasn't luck. It wasn't income. It wasn't even the size of their bank account. It was their credit score. For millions of Americans, a credit score is one of the most important financial numbers they'll ever have, yet most people don't fully understand how it actually works. Today, we're pulling back the curtain on credit scores and revealing how this powerful number can affect your financial future. At its core, a credit score is simply a numerical representation of how risky lenders believe you are as a borrower. Think of it as a financial report card. When banks, credit card companies, mortgage lenders, and even some landlords evaluate your application, they want to know one thing. If they lend you money, will you pay it back on time? That's where your credit score comes in. In the United States, the most widely used scoring model is the FICO score, which ranges from 300 to 850. The higher your score, the more trustworthy you appear to lenders. Generally speaking, a score above 800 is considered exceptional, while scores below 600 can make borrowing more expensive and sometimes even difficult. Many people assume that making a lot of money automatically leads to a high credit score, but that's one of the biggest misconceptions in personal finance. Your salary, job title, age, and investment portfolio do not directly determine your credit score. Someone earning $50,000 per year can have a significantly higher credit score than someone earning $200,000. Credit scores are based on behavior, not wealth. The system is designed to measure how responsibly you manage borrowed money, not how much money you have. The largest factor influencing your credit score is payment history. This category accounts for roughly 35% of your FICO score. Every time you make a credit card payment, auto loan payment, student loan payment, or mortgage payment on time, you're building trust with lenders. On the other hand, missed payments can significantly damage your score. Even a single late payment can remain on your credit report for years. This is why financial experts consistently emphasize the importance of paying every bill on time. Consistency matters more than perfection in almost every area of personal finance. But when it comes to payment history, consistency is absolutely critical. Another major factor is credit utilization. This refers to how much of your available credit you're currently using. Let's say you have a credit card with a $10,000 limit. If your balance is $1,000, you're using 10% of your available credit. If your balance climbs to $9,000, you're using 90%. High utilization can signal financial stress to lenders, even if you're making payments on time. Many experts recommend keeping utilization below 30%, while the highest credit scores are often associated with utilization levels below 10%. The length of your credit history also plays an important role. Lenders like to see a long track record of responsible borrowing. This means older credit accounts can actually help your score. Many people make the mistake of closing their oldest credit card because they no longer use it, only to discover that doing so shortens their average account age and potentially lowers their score. A longer history provides lenders with more data and makes your financial behavior easier to evaluate. Credit mix is another component that influences your score. Lenders generally like to see that you can successfully manage different types of debt. This might include credit cards, auto loans, mortgages, or student loans. You don't need every type of account to achieve an excellent score, but demonstrating responsible management across different credit products can contribute positively over time. Then there's the factor known as new credit inquiries. Every time you apply for a new loan or credit card, a hard inquiry may appear on your credit report. One or two inquiries typically won't have a major impact, but applying for multiple accounts in a short period can raise concerns among lenders. It may appear as though you're suddenly seeking a large amount of borrowed money, which can temporarily lower your score. What makes credit scores so powerful is how they affect real-world financial outcomes. A higher score can mean lower interest rates on mortgages, better terms on auto loans, easier approval for apartments, and access to premium credit cards with valuable rewards. Over a lifetime, the difference between a good credit score and an excellent one can save tens of thousands of dollars in interest payments. That's money that could instead be invested in a 401k, used to build an emergency fund, or put toward long-term wealth creation. The good news is that credit scores are not fixed. They're constantly evolving based on your financial behavior. Every on-time payment, every reduction in debt, and every responsible credit decision contributes to a stronger financial profile. Building excellent credit isn't about finding a secret trick or financial hack. It's about consistently demonstrating reliability over time. The system rewards patience, discipline, and smart financial habits. So the next time you hear someone talk about credit scores, remember that this 3-digit number is much more than a statistic. It's a financial reputation that can open doors or create obstacles throughout your life. Understanding how it works gives you the power to take control of it. And once you understand the rules of the game, you can start making decisions that move your score higher, reduce borrowing costs, and create more opportunities for your future. Because in the world of personal finance, few numbers have as much influence over your financial journey as your credit score.